we're in. Awesome. We'll give everyone a couple minutes to join. Welcome to everyone who is joining the webinar. While we wait, if anyone wants to write in where they're joining from and a fun fact or something like that, how long they've been saving for a home. Do I have the chat enabled in this? Let's see.
I think so. I'll put in my name.
Oh, did that work? All right. I don't see any chat. Oh, there we go. Okay.
I put in my email in case.
Perfect. Anyone else in the audience want to write in where they're joining from? If not, we'll get started in just another minute or two. All right, well, we can go ahead and kick off the introduction. We are recording this session, so we will be sharing this around after the webinar, but thank you everyone for joining our webinar today. I'm Kenzie Hagan. I lead growth here at Foyer. I'm calling in from our headquarters in Brooklyn, New York. Welcome to our September webinar. We are back this month again with mortgage lender Ari Wetzel, who's going to talk to you all about mortgage. We're calling this Mortgage 101, so everything you need to know about getting your first mortgage. For those of you who are not Foyer members already, we are a savings platform, savings and planning platform for first-time homebuyers. So we help you learn about how the home buying process, help you save faster for your down payment, and help guide you through the transaction itself. Welcome to the webinar. Ari, you want to introduce yourself?
Yeah. Thank you everyone for joining the webinar. My name is Ari Wetzel and I'm a loan officer with CMG Home Loans. I'm based out of Boston. Really excited to be here today. As a loan officer, you might be wondering what I do. My role is really to help individuals and families secure financing so that they can purchase a home. So I assist home buyers with understanding all of their mortgage options, guiding them through the application and pre-approval process, and then make sure that they can find the best program that fits their needs financially, their goals and their budget. So as I said, I'm based out of Boston, but I'm licensed in Massachusetts, New Hampshire, Vermont, Maine, and Washington. Washington State, if any of you are tuning in from those places. But that being said, a lot of what we're discussing today applies to all states. So thank you all for joining us.
Awesome. So the format of today's webinar is going to be just like conversational style. I have about 10 questions that I want to ask you that are frequently asked questions we get here at Foyer about mortgages. At any time, anyone in the audience, if you want to jump in, comment with a question, feel free to do so. If there's any follow-ups where relevant, please interrupt us. This is a conversation, and then we'll leave time at the end for Q&A as well. Awesome. So the first question I have for you is, at what point in your home buying journey should you talk to a lender?
Yeah, so I would recommend if you are thinking about buying a home, like within the next year, reach out to a lender. It's usually better to start with getting pre-approved and speaking to a lender or loan officer. I'm going to use those terms kind of interchangeably. Um, because they can help you figure out, your budget, not only, what you're pre-approved for, but making sure that whatever your monthly payment is going to be is actually comfortable for you. Sometimes you might be pre-approved for far more than you actually want to spend. So working with a lender not only helps you narrow down your range, but you can really make sure that it's a comfortable purchase price, and they can also help you strategize. If you don't have as much available for a down payment, what kind of loan programs are best for that? If you've got 20% available to put down, what are your best options in that case? So it's always great to start with a lender even before you start with a realtor. Usually when you go to meet a realtor, they'll ask you if you've been pre-approved. So there's nothing about the pre-approval process, at least at most companies and at my company, CMG, that is binding or that costs money. So you can always start that conversation, start the application, just to get an idea of where you stand.
Awesome. And just a follow up to that I had is with a pre-approval, does that impact your credit score?
Yeah, so in order to get pre-approved, we need to at least do a soft credit pull. Depending on who you're working with, they may not have the capability of doing a soft credit pull. We can at CMG, quite a few other lenders can, and we can work off of a soft credit pull for your pre-approval. But as soon as you go under contract or have your offer accepted, that's when we're going to need to do a hard credit pull for underwriting. So ask whoever you're working with, is a soft credit pull an option because it won't impact your credit, whereas a hard credit pull will temporarily lower your credit score.
Got it. That makes sense. And is a great segue into our most frequently asked question about mortgages. How does credit impact your mortgage?
Yeah, so your credit score does significantly impact the rate we can offer you. If I have two identical applicants, but one has an 800 credit score and one has a 650, I can give the 800 credit score person a much lower interest rate. So it's always a good idea. If you don't know what your credit score is right now, you should check. You can go to annualcreditreport.com and get a free credit report, and just see where you're at. And especially if you're not thinking about buying for 6 months to a year, you've got time to really boost that credit score. And if you can get your score in the mid 700s, above 800 would be exceptional, but even in the mid 700s, you're going to be looking at much lower interest rates compared to, say the low 600s.
Interesting. And by what range or how does that what is the impact on increasing your credit score from, let's say, a 650 to 700 or 750 to 800?
Yeah, you mean like how does that exactly change your rate?
Mhm.
It's a little different for everyone, but somewhere between probably around a quarter percentage point better if you make like a leap from 650 to above 700. But it depends depends on your debt to income ratio, some other things as well. But if you have an active application with a lender, they should be able to tell you, if you get your credit to this level, this is what we could work with. So yeah, it varies a little bit for everyone. But the one thing I did want to talk about is that there's different credit score minimums for each
Okay.
loan program. Maybe you were going to ask me that, Kenzie, but for conventional loans, which are privately backed loans, what most people get, the minimum credit score there is 620. So you're going to need a bare minimum of a 620 for a conventional loan. And then for government loans, they're a little bit more lenient. You're going to need at least a 580.
Okay. Okay.
Yeah.
Great. And what about co-borrowing? How does credit impact co-borrowers?
Yeah. So if we have two people co-borrowing on a loan, whether they're, a couple, they're friends, maybe it's like a parent and child, whomever it is, we look at both of your credit scores and we have to use the lower of the two. So if you're in a situation where maybe one borrower has really excellent credit and the other doesn't have as good a credit, it might be worth looking at, can we qualify with just that one borrower's income? A lot of cases you do need both borrowers' income to qualify, especially with the way home prices are so expensive, and a lot of times you need at least two borrowers. But that is something to keep in mind, that you could have someone with an 850 credit score and someone with a 600, and all we're going to operate off is that 600.
Got it. Okay. Okay, great. Thank you for clarifying that. Any
Yeah.
follow-ups from the audience on that or any specific co-borrowing questions? I know that's a topic that comes up a lot.
You can have up to 4 people co-borrow on a loan, and they don't need to be relatives. You want to consider who you're co-borrowing with, of course. But I've seen friends co-borrow together. So there's a lot of options.
Yeah, I read an article that millennials are like co-borrowing with friends at a pretty high rate. Like I forget what it
Yeah,
was, like 20-30%, something crazy.
yeah, yeah.
Cool. Well, if any questions come up, feel free to drop them in the chat. I'm going to move on away from credit, but what is the minimum down payment you need to put down on a house as a first-time home buyer?
That's a great question. This is one of the most common questions I get. So it's a common misconception that you need 20% down. For conventional loans, you're likely looking at a minimum of 3% down. 3% down is for folks with pretty good credit, something in the 700s and above, usually. You can depend, if your credit's a little bit lower, like in the 600s, you can still qualify for a conventional loan, but you might need to put like 5% or 10% down. And then the other side of that is government loans. So there's a few different kinds of government loans, but the most common one among first-time home buyers is an FHA loan, and that is a minimum 3.5% down. And then there are 2 government loans that have 0% down options. A VA loan, so loans that are for eligible veterans or widows of veterans, or USDA loans, also called rural development loans. So those are loans in more rural areas, usually like farmland, agriculture, and USDA loans. The one thing to note about them is that they have an income limit, so not everyone qualifies for that, based, not only on property location but income. So long story short, you don't need 20% down. Most first-time home buyers average around 6 to 7%, so somewhere in there. But yeah, like I said, you're probably looking at a minimum of 3% in most areas.
Okay. And for that USDA, the rural development loan, the income limit, does that vary by location or is there like a
It
standard?
does. It varies by, we call it AMI, area median income. So
Okay.
you can actually look up, I can share a link after, but there's like an interactive map where you can not only see what areas qualify geographically for USDA loans, but you can also click and see the income limits for that area.
Okay, great. That would be helpful. Yeah. And if anyone has any specific questions, feel free to email Ari. Um, Great. So that kind of is a nice segue into the next question, which is about down payment assistance programs.
Yeah. So in a lot of areas, there are down payment assistance programs, especially for first-time home buyers. In the Boston area, there are state programs as well as city programs. So that's likely true wherever you guys are tuning in from. There's probably some sort of housing authority in your area that offers down payment assistance. And there's really 2 major kinds of down payment assistance. Grants and loans. So grants are the best because you don't have to pay them back. Through the city of Boston, there's actually a program where you can get $35,000 in down payment assistance as a
Wow.
grant if you qualify. So, a lot of money. But what I see more commonly is down payment assistance in the form of a second mortgage. So in addition to the primary mortgage you're taking out on your home, let's say you're putting 3% down, so you're taking out, a 97% loan to value mortgage. In addition to that, you're going to have a second mortgage, and that mortgage usually, because it's down payment assistance, is either at 0% interest or like a really low level of interest, like 1 or 2%. And then it's more favorable than putting it into your primary loan because the interest is so much lower. But there are certain restrictions with that as well. Like if you sell or refinance, usually that second loan is due. So it really depends, if you're going to refinance in a year and your down payment assistance is going to be due in a year, and all of a sudden you're like, I don't have, I can't come up with the $10,000 I got in down payment assistance. Work with your lender to strategize, is this actually a program not only that I'm eligible for, but that I should take advantage of? But yeah, like I said, almost every state has something. And if any of you guys tuning in from wherever you are, by all means send me an email and I can help you figure out what's available in your state. I can even help you find a good lender in that area so that you can take advantage of any programs you qualify for.
Awesome. And one more question on these second mortgages or grants. From
Yeah.
a timing perspective, does that typically is that typically something that the buyer needs to save up a certain amount and that comes in the form of like almost a rebate or a cash back, or is that essentially like you have to save up to the amount you're going to put down minus the grant, for example?
Yeah, the latter. So if your down payment and closing costs are going to be $50,000 and you are going to get a $25,000 down payment assistance loan, you really only need to bring $25,000 to closing. You don't need to demonstrate that you had that money saved in the first place, if that's what you're getting at. Yeah.
Awesome. Okay, very helpful. Okay, my next question is more about the role of a lender in the pre-approval process we talked about, but what about shopping rates? At what point do you shop rates? What does that mean? What does that process look like?
Yeah. So while you're, looking around at homes, you may also be shopping around with lenders. And I do think that that is a good strategy to get the lowest rate because, if you have a lender you really love and trust, by all means go with them. But if you maybe are talking, you can talk to two or three. I probably wouldn't go above three lenders in your area, local lenders, credit unions, whatever it is. I would, we can get into this later, but I would avoid the big banks. If you can get kind of estimates from each of those three, and you can even go back to, say, your favorite loan officer and say, hey, we really like working with you, but XYZ bank is offering us a 0.5 percentage point lower. Can you meet us there? Can you price match? A lot of us have that capability to kind of like escalate things and say, hey, we're matching a competitor. So that's a great strategy to get your rate a little bit lower. I would, though, once you have an offer accepted, if you have not already selected your lender, I would select your lender within the next 3 days, because if you start the process with multiple lenders, which you legally are allowed to do, both of those lenders and their teams are going to be coming at you for information, your W-2s, your pay stubs, your bank statements, and it's just going to make your life really stressful. And frankly, you can get a good feeling from the lenders even before you have an offer accepted of who you like working with and who's offering the programs you want at the rates you want. So if you can make that decision even before you have an offer accepted, that is wonderful. But if not, once your offer is accepted, like within 2 or 3 days, I would say decide, because it gets a little hairy if you're trying to switch after that.
Okay, and can you share some insight on the timing of all of that? Like, how long does it take to actually secure a mortgage?
Yeah. So usually from offer accepted to closing date, like keys in hand, is 30 days. But there's a lot that goes on in that. So once you have an offer accepted and you tell your lender, then they have 3 days. If you have a complete application with them, they have 3 days to get you initial disclosures, which includes a loan estimate. So kind of like the initial proposed terms of your loan, we legally have to get that to you within 3 business days. Then you can review that. And then we start the underwriting process. So we get a bunch of documents from you and we order your appraisal. And an appraiser will go out, to your property, assess the value of your home, make sure that the value is, at least what you're paying for it. If it comes in undervalue, there's some options, but we don't really have to get into that right now, unless you guys have specific questions about appraisals. But yeah, so then between all of the borrower documentation and the appraisal, we send it through underwriting. Underwriting takes probably like 2 weeks. And then we get you a commitment letter. And that commitment letter is like a super strong version of a pre-approval, where we're saying we are committing to giving you this money. You have cleared all of our underwriting requirements. And usually the seller or seller's agent is looking for that at least a week before closing to make sure everything's on track. And then you'll be, once we issue the commitment letter, you're what we call clear to close. And so it's just a matter of making sure, you know where you're wiring your money, you know how much you're wiring, or bringing in a certified check. Some people still do that. Most people wire now, but then yeah, that's really it. But by 3 days before closing, you will have your final closing disclosures from your lender, and those closing disclosures look very similar to the initial disclosures you got, but now it's finalized, your rate is locked, every dollar is accounted for, every cent, and you know exactly what you're paying. So that's kind of the overall process. 30 days gives us enough time not only to get the appraisal done, but to do underwriting, and if there's any bumps along the way, gives us enough time to kind of fix it and get back on course.
Awesome. Thank you for that overview. I will leave some time. We have a couple questions in the Q&A inbox. We can answer those. And if anyone else has any questions about the mortgage commitment process, that was a lot of information. So feel free to jump in. But the first question we got from the audience is, how does the new law, okay, so this is about the buyer's agent commissions and the NAR settlement. How does the new law work with who pays the buyer's agent commission?
Mm. Yeah, so for those that aren't familiar, the National Association of Realtors recently had a settlement agreement where it used to be very much standard practice that the seller paid both agents. So, you know, if you're buying a $500,000 home and the agents are each making 3%, what's happening is 6% of that $500,000 is being taken kind of out of the seller's pocket. So that's why we say the seller's paying for it, 3% going to each agent. Now, under the new regulations, sellers can choose whether or not it actually was never a law that they had to pay before, but it was very much standard practice. And now it is not necessarily going to be standard practice. We're still seeing how things are changing, but now as a buyer, you're not necessarily guaranteed that that seller is going to pay your agent. So you may have conversations with your realtor on, you know, should we go look at this listing? They are not offering buyer's agent compensation. You as the buyer now have to decide, am I comfortable compensating my agent another, you know, 2-3% on top of what I'm already putting down on my home? I will say a lot of listings I see still have the sellers paying both agents. But it's going to be a conversation you have with your realtor. I mean, the other thing is sometimes they'll pay like 1% of your agent's fee and you're responsible for the other 1 or 2. My concern there is that it's going to trickle down to the folks that have trouble with home affordability in the first place. But we're having a lot of conversations with the National Association of Realtors, even with like our state representatives on what exactly this means and making sure that it doesn't impact affordable housing.
Yeah, great answer. And we actually published a blog article recently with a letter from our founder about this topic and how what we're seeing, how we're anticipating this to play out. So I can share that out as a follow-up to this webinar as well. Thank you for that answer. Okay, the next question is, purchasing a home with cash, how can I qualify for grants or down payment assistance programs that I do qualify for based on income? Is that an option, I think is the question.
Yeah, so it depends what's available in your area, but there are options. I mean, as long as, like you said, qualifying based on income, some down payment programs or cash assistance programs do have an asset maximum. So for example, the City of Boston program I was talking about, you can't have more than $75,000 saved, excluding retirement accounts. So if you're buying in cash, you may have high enough assets that you don't qualify for the program in your area. But that being said, a lot of programs have no asset restrictions, so there may be some options. Sky, if you shoot me a message on where you live, I can look into it and see what might be available to you.
Awesome. Okay, great. So thank you for that. Let's move on to the next question in the interest of time here. So you talked about there being various types of lending partners. Can we talk about what those are? What are your options to get a mortgage? Like
Yeah.
mortgage, like banks, direct lenders, credit unions, and what's sort of your take on the different experiences with those different types of lenders?
Yeah. So a lot of first-time home buyers, when they, you know, are ready to buy, they are maybe banking with Bank of America, Chase, Capital One, you know, these big banks that a lot of us bank with. And so that's that's a natural first thought to think I should go to that bank for a mortgage. But there are some challenges that come with big banks. One, it's going to be a less personalized experience. So when you work with a local lender or a credit union, who, I would also consider a local lender, they're going to really talk with you one-on-one, learn about you. They probably, I mean, best case scenario, they also like know your realtor, so you have a good team working together. So the big banks, a little bit less personal for basically the same cost. They're not going to save you. They charge about the same, lenders fees that we charge, for a more personalized experience. The other thing to consider is when you're making offers on homes and you're submitting your pre-approval letter with your offer, a lot of agents would prefer to see a local lender because they know you've been vetted more closely compared to, a printout from Chase Bank. So it can also make your offer a little bit more competitive if you use a local lender. Just do a little bit more due diligence. We're here to answer your questions, a little bit more tailored one-on-one experience. When it comes to credit unions, if anyone is a member of a credit union, I do think it's worth reaching out to them. Sometimes credit unions have lower fees and lower closing costs associated with them. The restriction with credit unions, though, is that they may not offer all of the programs you want. Not every credit union offers government loans, so like FHA loans, whereas a lender, like CMG, we basically offer everything. So you want to make sure that whoever you're working with has all of the options you need. If you're going to do renovations, if you're going to do construction, if you're buying a condo that needs certain, requirements. So yeah, I would definitely push for the local lender or, credit union route over a big bank.
Makes sense. And just to make sure, just to talk about to the audience, there's no, if you do set up multiple calls with different lenders, different types of lenders, there's no commitment, right, to
No.
working with any of them. It's sort of like you're interviewing them in a way, or you're just gathering information, right?
Yes, exactly. The only time you really are committing is you can basically, I mean, I wouldn't recommend it, but you could pull out up until 3 days before closing, or you could even switch lenders 3 days before closing. There's no way that 5 days before closing, you're going to be able to go through the underwriting process with another lender. So I would definitely do not recommend switching at the last minute, but there is nothing legally binding you to work with us. We don't collect any, sort of payment until at closing. We have fees, similar to like your title and settlement company that are charging fees for the transaction. Our fees are $1,450 for, loan origination, processing, underwriting, all of that. So that is the only fee we collect at closing.
Got it. Thank you for clarifying. And we got a couple more questions in from the audience during this time. So this is an interesting question. How rigorous is the transparency in letting a lender see all of your finances? So like specifically on your credit card and bank statements, are there any red flags that we can avoid? Like stop spending money on trips, unnecessary things, just to be able to afford it. I like this question.
Yeah, me too. So when we do a pre-approval, all we see is, I'm speaking from most lenders function like CMG, so I'm making broad brushstrokes here. But what we see is we see your credit report. So we'll get your full credit report. We'll see all three credit scores from all three bureaus, and then we'll also see, your student loans, not only the amount you owe, but the monthly minimum, because we use that monthly minimum in your debt to income ratio. We see car payments, we see every credit card, so every like revolving line of credit as well. But we can't see what you're doing with that money. So like if you have $10,000 in credit card debt, there's really no way for me to know what that debt is. And honestly, even if I did, there's no way for me to see. That being said, when you go under contract, we will ask for 60 days of bank statements. And that is not because we actually care what you're doing with your money, but just to show that you have the money available to cover your down payment and closing costs. So, if you're expected that you need $100,000 come closing day, we want to see that in your bank account liquid so that we know that you can actually pay that at closing. The only things, once you're under contract and you're, actually going through the underwriting process, the only things to really be conscious of are major purchases that are going to, increase your debt. So like don't take out a new car loan. Or check with your lender before you do. Some people, maybe you have enough wiggle room, you can do that. If you take out a new credit card or have any hard credit inquiries, we're going to ask you about it. So just avoiding taking on new debt during that time, because everything we've done for your pre-approval is based on your current finances. So yeah, just give your lender a call if you're, I had someone the other day who he knew he was going to do a lot of renovations on his home. So he took out a Home Depot credit card. He called me a week before closing and said, "Hey, is it okay if I take out a Home Depot credit card with a $2,000 limit?" I checked. I said, "Yep, go for it. No problem." So really, yeah, have a conversation, but we really don't care how you're spending your money, just as long as you have enough to get to closing.
Awesome. Great question and great answer. Thank you. The next one is, what are examples of junk fees in closing?
Junk fees. So, I mean, there are, that's a good question. I mean, there should be no junk fees is the answer. But one thing to look for is if you're getting quoted rates, what you want to do is you want to, especially if the rate seems like a lot lower than every other quote you're getting, is you want to check your loan estimate, ask if they can provide you with a loan estimate or a quote, and check if they're charging you points. And what I mean by points is that's a way to buy down your rate. So sometimes lenders will try to get you on the hook and say, we can give you a 5% mortgage rate. And then all of a sudden you're looking and you're like, why does that rate cost me $12,000? And it's because they're adding in points. Any good lender, I would never charge a borrower points without explicitly making sure that that's what they wanted to do. I would never put that in a loan estimate without checking with them first. And honestly, in a refinance environment, you probably don't want to buy down your rate right now anyway. So when you look at your loan estimate, there should be in the upper left corner. I can like send out if people want to look at what a loan estimate looks like. But in the upper left corner, there's a section called origination charges, and in there it will say percent of loan points charged to borrower, and it will either be blank or say 0 if there's no points. If there are points, it should be disclosed there, and you'll see it in your cash to close. So when someone's quoting you a rate, get it in writing and ask if they can give you a loan estimate for that rate.
Awesome. Hopefully that answers your question. We got a couple more. So I think this is getting at what happens to a mortgage after closing. Are mortgages sold off to other lenders, et cetera?
Yes, so that is very common. We refer to that as selling for servicing. So my company doesn't do that, but a lot do, and that's because it's a way basically. So when we originate a loan, say it's a $500,000 loan, we give $500,000 to a client. We then don't have that money, of course. So what lenders do is they will sell it on the secondary market, basically to get that capital back. Or, it's really a financial decision that a lot of lenders started doing the past couple of years because the mortgage industry has not been nearly as profitable as it has been in the past. So a lot of lenders are selling servicing. Nothing about your loan should change. Your your rate, your loan amount, all of that should be identical. The only thing that should change is that now you're paying a different mortgage company. And so that is something that can be frustrating as a borrower. If you're working with me and you expect to get a CMG loan and expect to make your payments to CMG, and all of a sudden it's serviced by someone else, that can be frustrating. But it shouldn't cost you any extra money. It's pretty darn common in this market. So, yeah, but by all means, ask your lender. Say like, hey, do you sell loans for servicing? And also, a lot of lenders, if that's really a holdup for you, they can guarantee they might be able to guarantee that they retain it themselves for servicing if that's something you really want to avoid.
Awesome. Thank you for that answer. And that was another great question. Okay, we have one more question in the inbox right now before we get back to some of the other questions I had, but this is a good one as well. If you were added as an authorized user to someone else's card, does that act the same as if they were the primary card holder?
Yes, it does. So whatever the monthly minimum is on that card, we're going to consider that as a recurring debt for you. Most credit card minimums are pretty low unless you have a really high balance. So usually it's 25, 35, $40 a month. So not a huge deal. The issue that I sometimes run into with people is, if they are if they co-signed on someone else's mortgage, we have to consider that mortgage as if it's your own. Or if you co-signed on a car with a relative, we have to consider, even though you might be splitting those payments, even though you might not be paying it at all, we have to consider that it is a debt that's, legally assigned to you. So yeah, it's not a bad idea if you think some credit card payments are going to be holding you back to, maybe consider getting off that credit card, or exploring some other options.
Interesting. I did not know that.
Yeah.
Um, okay, great. So my next question for you is about fixed rate versus adjustable rate mortgages. What are the difference between those? What are those, and what are the differences?
Yeah. So, a fixed rate mortgage is exactly what it sounds like, and that your interest rate will never change. As long as you have that same mortgage, your interest rate should never change. So, you sign up for a 6% 30-year fixed rate mortgage for 30 years, again, assuming you're not refinancing. For 30 years, you are going to be paying a 6% interest rate on your mortgage. Your principal and interest payment will be identical every month. The thing that may change is, well, the thing that will change is your taxes, your homeowner's insurance, and if you're in a condo, your HOA fees. So those things can fluctuate. So your total monthly payment, really your comprehensive monthly payment is probably going to keep going up along with your taxes and insurance, but your mortgage will not, which is really refreshing to those of us that are familiar with the rent increases that, you deal with. So, yeah, that's part of the math I talk a lot with first-time homebuyers is, you might be paying $2,000 in rent now and your mortgage might be 3, but in 30 years, your mortgage is still going to be $3,000. And I can guarantee you in 30 years, your rent is not going to be $3,000. So, that's a fixed rate mortgage. Adjustable rate mortgage, those come in all kinds of shapes and sizes. Very common adjustable rate mortgages are 3, 5, or 7 years. And what that means is usually your rate is lower for a certain amount of time. So let's say it's a 3-year adjustable rate mortgage. Then for the first 3 years of your loan, your rate is probably going to be lower. Sometimes it steps each year, but sometimes it's flat. And then at year 3, it's going to adjust to the market rate or whatever the cap is on your ARM. Usually ARMs have a cap, so they can only increase by so much. But when that 3 years is up, assuming a 3-year ARM, your rate, your payment's going to go up. So it's it can be right now, ARMs aren't priced as competitively because we know rates are going down, so investors are not pricing them as competitively, but it can be a good option if you know you're only going to be in a house for a short amount of time, like 3 to 5 years. That being said, I'd say like really make sure that's how long you're going to be in the house because, I know a couple of people that bought during COVID when rates were really low, 3%, and they got into ARMs and now they're, thinking about staying and their rate adjusted and they really should have taken advantage of a fixed rate mortgage. So yeah, again, another conversation to have. How long are we going to stay here? Even if we move, are we definitely going to sell or are we going to hold on to the property? So most people stick with a fixed rate mortgage, especially in the way rates are right now. But yeah, something to consider.
That's interesting. I was going to ask about refinancing. I know you mentioned that earlier, but can you switch between a fixed rate and an
You can.
adjustable?
Yeah, you can refinance into any loan program that you're eligible for. So, if from the get-go you're deciding between a fixed rate mortgage and an adjustable rate mortgage, likely 3 or 5 years from now, you're still going to be eligible for both of those options. Similarly, if you're in a 30-year fixed rate and, let's say your income has increased significantly, or, maybe you have a partner that's now contributing to the mortgage, you can refinance that 30-year mortgage into a 20-year mortgage and save a lot on interest. And there's 10-year, 15-year, 20, there's just about any kind, any length term, there in 5-year increments, that exists. So, yeah, and the rate is going to be, not only are you paying the loan for a shorter amount of time, so you're going to save money, but also the rate is lower for those shorter term loans. So, yeah, you might be surprised, those of you, if you get a 30-year mortgage and you feel like you could take on a little bit more, look at a 20-year. It could save you truly tens of thousands of dollars. So, yeah.
Wow. How does refinancing work in general? What is that process like when, you cited some examples of when one might refinance their mortgage, but what does that actually
What
look
does it
like?
look like? Yeah. So it's just replacing your old mortgage with a new one. So if you've applied with a lender before, like let's say you purchased your house with this lender, they already have a file for you. They already have a lot of your information. You might need to give them updated pay stubs. You might need to give them updated bank statements, but it's kind of like a slightly fast-tracked version of applying for your mortgage in the first place. And yeah, we replace it with the old one. There's closing costs associated with the refinance again. So refinancing is not free. It costs money, although some lenders are offering free refinancing, including CMG. But if you, yeah, it's you want to do the math, because if the rate moves an eighth of a percentage point or a quarter percentage point, it might not be worth it. It might be worth it for you to wait until maybe rates have moved a half percentage point or a full percentage point, because refinancing does cost probably around, at least a few $1,000s, if not up to like five, six, $7,000, depending on your loan amount. So, yeah, you can refinance. Usually lenders restrict you to waiting 6 months after your initial purchase. That is a restriction we have at CMG, that you can't refinance within those first 6 months. Honestly, rates don't usually move enough that you want to refinance, but once those 6 months are up, yeah, a good lender will reach out to you and tell you you're eligible to refinance. But if not, keep an eye on rates. You can look online at like average mortgage rates. Look when you closed or when you locked your rate and look at what they are now. And if rates have gone down by a half percentage point or more, um, it's probably a good time to refinance. So, yeah, just save on your monthly. There's a few different ways to refinance. Most common is called rate term, where all we do is we take the exact same mortgage, replace it with a new one at a lower rate. You can also, if you've got a lot of equity in your home, you can refinance and you can take cash out of your home. If you have a big purchase or you want to do a renovation. So there's a lot of options.
Great to know. Great to know. Refinancing is something that we don't talk about too often. Just, we mostly are talking about getting to, closing
Yes.
uh,
Yes.
here
But
at
it's
Foyer.
true, like the mortgage you have now is not the mortgage you're going to have 30 years from now. There's just no way. So, yeah, refinancing is a great way to save money. And unfortunately, usually it's really the kind of financially savvy borrowers that take advantage of it. But any good lender should reach out to their clients and tell them, and yeah, if you didn't like your lender the first time around, go to someone else. So, yeah.
Good to know. Good to know. Thank you. We have a couple questions in here, and I'm gonna open up the floor for questions again in case anyone has any follow-ups about refinancing or anything really. But we have one here about PMI. So we can avoid
Hmm.
PMI if we put down enough, right? Um, First, maybe we should explain what is PMI.
What PMI? Yeah. So PMI stands for private mortgage insurance, and that is required on any conventional loan if you put less than 20% down. The less you put down, the higher your PMI. So, if you're putting 5% down, maybe your PMI is $150 a month. If you put 15% down, it's going to be a lot less. And then and this is for conventional loans, as soon as you hit 20% equity in your home, you can cancel it. So this is not something you're going to be paying for the life of the loan, just until you hit 20% equity in your home. Um, the other side of that is for government loans. Government loans also have mortgage insurance affiliated with it. It's not private mortgage insurance, it's federally backed mortgage insurance. And it's at a very set rate. I believe it's 0.0075%, or 0.75%, I should say, of the loan value, but I can check on that. But basically, for an FHA loan, there's always going to be mortgage insurance. So no matter how much you put down on FHA, there's going to be mortgage insurance for the life of the loan. Usually the mortgage insurance is a little bit less than what you might be paying in conventional, but it really depends on the borrower. I've had conventional borrowers that their PMI is like $80 a month because they have got awesome credit and low debt to income ratios. Whereas, it might be a little bit higher for an FHA loan. I'm I'm kind of reading ahead to the next question, Kenzie,
Okay, yeah.
about would you recommend getting an FHA loan and pay the PMI, or wait to get a conventional loan and save on the PMI? Um, That's a great question. I think for a lot of people, it makes sense to start out in an FHA loan if it offers you at that moment better terms, better rates. So like some people, their credit may be right around 600. They can, or let's say your credit's 620. So you qualify for both conventional and FHA. Your rate for a conventional loan, because your credit is on the lower side, might be much higher than an FHA loan. So in that case, I'd say start with the FHA loan, pay the monthly insurance. Once you've had your FHA loan for, 6 months to a year and you're making your monthly mortgage payments on time, your credit's going to go up and you might be eligible to then refinance into a conventional loan. At that point, you probably would not have built up enough equity in your home to be above that 20% mark to avoid PMI altogether. But it's a way that you can start FHA, boost your credit, switch to conventional, and then work towards that 20% equity so that you're not stuck with it for the life of the loan.
Awesome. Hopefully that gives you answers your question. So the next one is about refinancing as well. About someone who has a monthly adjustable rate mortgage. Another bank is offering a 3.3 adjustable rate mortgage with a 1% lower interest rate. Is it worth it to refinance?
Depends what they're currently at. And it depends what the cap on the ARM is. So usually ARMs, they start at a certain level and then they can adjust like either every 6 months or every year. It depends what that cap is going to be. Like if the ARM has a hard cap at, well, let's see. So they currently have an ARM, a 3.3 ARM with a 1% lower interest rate. So it's going to bump up. Okay. So it's going to bump up at year 3 by a full percentage point. If it's going to bump up to above 6%, or above 6.5%, given today's markets, I would say consider refinancing before it bumps up. But if it bumps up to a rate that is, kind of on par with the market or even lower, stick with it while you can. It really depends on what it's going to adjust to. But if you know it's going to adjust to say 8%, refi before it does that. Refi into either another ARM if you want to look at another ARM, or refi into a conventional fixed rate so that, your payment won't increase on you.
Awesome. All right. So my next question for you, Ari, is what happens to my mortgage once I sell my house?
Great question. So when you sell your house, hopefully, in almost all cases, your home is going to sell for more than you owe on your mortgage. And so what you do is you take the proceeds from your sale and you pay off your mortgage. You can reach out to your loan officer to do that. There's a way to do it online, usually pretty quickly. But yeah, you pay off your old mortgage, and let's say you're moving on to a new home. You can use those extra proceeds towards your down payment, or take out another mortgage if you need to on your other home. You can have multiple mortgages at the same time. So it's not like you need to pay off one before you can get another. That there are restrictions on that for FHA loans, but for conventional loans, you can have, as many as you qualify for. So, you basically close out that loan once you sell your house, pay it off, and then, move on to the next.
Exciting.
Yeah.
All right. Well, I have one more question for you, and then we will just open up the floor for Q&A for the remainder of the webinar. But are there any common mistakes that you see from first-time home buyers that you can share, that you can help our audience today avoid?
Yeah. So a lot of people skip right to the fun step, which is looking on Zillow at homes. I get it. That's really fun. And they want to start touring, and you might even like click that Zillow link that says like, hey, I want to see this property. And you probably get like matched with a random agent. That agent might be great. They might not be. So first step, before you get on Zillow, is talk to a lender, narrow down your price range, because as soon as you meet with that realtor, I guarantee you they're going to say, hey, are you pre-approved? What are you pre-approved for? So that they know they're not taking you to homes that you just really can't afford. So number one mistake, not getting pre-approved before house hunting. Number two would be overlooking closing costs. So in addition to the purchase of your home, there's other fees associated with purchasing your home. And usually like a good spot to budget is 2% of your purchase price. So if you're buying a $500,000 home, assume that you're going to have about $10,000 in closing costs. And that $10,000 isn't, it's not money out the door. Some of it is. Some of it's going to your lender, your attorneys, or your title company, but some of it's going into an escrow account if you're escrowing. And what escrowing means is, in addition to your mortgage payment, your principal and interest, every month you can pay 1/12 of your taxes and 1/12 of your homeowner's insurance, and your lender will pay those for you. So most people choose to do that because it's kind of like a no-brainer, and it's a way to kind of budget for your taxes and insurance where you don't have to make like a lump sum payment at the end of the year. But what we do is we collect that. We collect the 12th, the 12th, the 12th, and then it sits in escrow, which is like a third party bank account. And then when your insurance is due and your taxes are due, usually taxes are due quarterly, we pay them for you, so that you never miss a payment. We don't want you missing a payment. We don't want a lapse in insurance. We don't want a lapse in taxes. So we're willing to do that on your behalf. So anyway, closing costs, about 2% of purchase price, budget for that. And then the other thing is don't drain your savings account. Don't drain all your money into this. You really should have at least 3 months, preferably 6 months in reserves. And what I mean by in reserves is if you lost your job, if you had no income, could you still pay your mortgage, buy groceries, pay for daycare, whatever it is? Keep that on hand, because you just never know when, you never know if you're going to get laid off. You never know if your roof needs an emergency repair. So, yeah, that's a good reason, honestly, to tap into down payment assistance programs. If you're looking at really, being, having very little money saved at the end of the transaction, I don't want you to be in that position. You don't want to be in that position. So, work with a lender to make sure, either getting some sort of assistance or finding something that's more in your budget.
Awesome. Those are all great tips. Thank you very much.
Yeah.
If there's any other questions from anyone in the audience, we'll stick around for a few more minutes. But thank you all for participating in this webinar. Thank you, Ari, for sharing your knowledge with us. This webinar was recorded, so I will upload this to our Foyer blog and share the link around. There are a few specific follow-ups, which I will include as well. But as always, if you have any questions, you can email me, you can email Ari, email hello@foyersavings.com. We are here to support you in your home buying journey.
Absolutely. Thank you, Kenzie. And thank you for everyone who joined.
Awesome. All right. Well, have a great night, everyone.
Yeah, have a good night. Bye.
Bye.